Hi, good evening. You're watching Business Plus on News9 Live. I'm Kartik Malhotra. And first up, let's dive straight into the numbers that are coming in. This is earnings season. Yesterday, we had TCS, the bellwether, and today we have yet another Infosys. I've got my colleague Suyash here to update us on the latest numbers coming in from Infosys Q4 earnings. Suyash, what are we seeing?
So Kartik, Infy also has missed the street estimates. Now, sequentially, it was a weak quarter for the IT bellwether.
Okay.
Infosys reported a 16% decline in total profit after tax in Q4. Now, the IT giant's Q4 profit stood at about 6,128 crore rupees, which was down 16% on a sequential basis.
Okay.
Now, the company's revenue also dropped. It dropped by 2.2% on a quarterly basis to about 37,441 crore.
Okay.
The company's revenue growth in constant currency terms was 3.2% quarter on quarter and 8.8% year on year. Now, the operating margin stood at about 21% in Q4. For the full year, the company reported a constant currency revenue growth of 15.4%, which also missed the company's guidance of 16 to 16.5%. Now, Infosys began the year with a guidance of 13 to 15% year-on-year growth in constant currency terms and went on to increase the guidance quarter after quarter. Now, the deal wins during the quarter stood at about 2.1 billion. This was the lowest in the last 3 quarters. Deal wins during the December quarter now stood at 3.3 billion. The company also has declared a dividend. The dividend is 17.5 rupees per share for financial year 2023. Now, the guidance coming in from the company is that the management expects the revenue in the financial year 2024 to grow at about 4 to 7%. Now, the street, on the other hand, had expected the number to be in the range of 6 to 8% in constant currency terms.
So what does this really mean for the investor of Infosys, Suyash? Of course, guidance is something which is always good, but it is never watertight. It's not something that you can actually hold the management, accountable for, because we've seen, especially in the US, and Infosys has a bulk of its clients in the US, in fact, the entire IT sector for that matter. So for the investor in Infosys, what do these numbers really mean?
So even the commentary coming in from TCS yesterday, they said that the big impact was because of the clients in the US, they delayed their orders, and because of that they suffered a revenue miss. So they are feeling that pain, the pain in the banking system back in the US. And now it's very important to note that the BFSI sector contributes to about 30 to 38% of the entire revenue of these 3 IT giants. So if there are problems in the banking system, it will show up, and maybe not in the numbers in this quarter, but in the quarters to come, we can expect that numbers, the problems in the banking sector, the problems with the clients, the deals which are getting postponed, the numbers to show up in the quarters that are coming forward.
Okay, we also heard Salil Parekh, in fact, talking about generative AI being one of the key drivers for this financial year. Did you hear something like this from TCS as well? Is this a trend you think that all IT companies would be going in for at this moment? Because AI seems to be the buzzword for everyone across the world.
Yes. So since TCS has missed the estimates, they majorly spoke, since the results came out, they have majorly spoken about the miss and come out with the explanation. And the other big point is the change in the management that is going to take place in June.
Right.
So nothing from them on the developments, at least as far as AI is concerned. That's where TCS stands.
Okay, great. Suyash, thank you so much for joining us. And of course, that's the update on Infosys. And remember, we are in the earnings season. Q4 numbers have begun to come in, and the Nifty 50 pack sort of, in focus for us. Yesterday we had TCS. Today we've got Infosys, and going forward, as and when numbers from the Nifty 50 pack come, you can catch them all here with me and with Suyash. Suyash, thank you so much for joining us. But it's a day of numbers, and in fact, AMFI, the Association of Mutual Funds in India, has also released mutual fund numbers for the month of March 2023. Of course, if you remember, this was the time of the end of the financial year when debt mutual funds had stopped becoming lucrative. And let's just run through some of the numbers that have come from AMFI as far as inflows and outflows into the mutual funds are concerned. So Inflows into equity mutual funds surged to a 12-month high in March. This, of course, was aided by investments in sectoral as well as thematic schemes. Net investments in equity as well as equity-linked schemes increased 31% over the previous month to 20,534 crore rupees in the month of March. That's the highest figure, incidentally, since March of 2022, with equity funds now recording inflow for 25 straight months. All equity mutual fund schemes recorded net inflows in March. Sectoral or thematic schemes saw the highest investments, followed by dividend yield small and mid-cap funds. Meanwhile, focused funds received the lowest inflows, followed of course by multi-cap funds. Now shifting focus from equity schemes to the debt mutual funds, and these of course were the critical funds that everybody was watching. Debt mutual funds, as expected, saw heavy outflow in March 2023. Now, last month, debt mutual funds reported an outflow of 56,884 crore rupees. That's the highest in 6 months. This, of course, also comes at a time when there is tinkering in the rates and safer instruments like debt are finding other avenues in fixed deposits and bonds. Now, in the calendar year 2023, the debt category has seen total outflows of over 81,000 crore rupees. Among the categories, liquid funds saw the highest outflow of nearly 57,000 crore rupees, followed by money market funds. Liquid funds are preferred by investors to park their money for short periods. They invest predominantly in high liquid money market instruments, debt securities of very short tenure, and hence provide high liquidity. According to AMFI, the outflow from liquid funds was expected, as this is normal treasury management at the end of the financial year. Companies need to pay advance tax, and interest rates, like I said, have peaked, so investors find it more attractive to invest in debt funds. Now, investments via SIPs, systematic investment plans, topped the chart at 14,000 crore rupees, and this is for the first time ever. SIP contribution last month came in at 14,276 crore rupees compared to 13,686 crore rupees in the month of February. Harsh Rungta joins us. Harsh, thank you so much for joining us here on Business Plus. Initial thoughts looking at AMFI data, Mr. Rungta, what do you see?
I think very clearly the mutual fund bandwagon clearly marches on, and correctly so. It is the mutual funds have something for every investor. You want to invest in debt instruments, it will have debt mutual funds. You want to invest in alternates like gold, you would have gold index funds or gold ETFs. You want to invest in equity, of course, there are various categories of equity. Some of them you just mentioned. It can be cut by caps, it can be flexi caps, multi caps, large, mid, small. Biggest, it can also have a lot of hybrids. So you can mix and match, and that can, do auto balancing on its own. I think this very clearly the mutual funds have got the fancy of the retail investor. A lot of regulations that have been brought in by SEBI has aided that. The campaign mutual fund Sahi Hai has aided that. And I think we are going to see much further growth from here on. And the most heartening thing among the barrage of information that you gave was that SIP number. That if you see through, lows and highs, it has been steadily inching up. And that is pure retail money. I mean, it would not have non-individual investors there. I think that is a very, very heartening sign. $2 billion every month, predominantly in equity, although there will be some amount of debt there, but predominantly in equity and hybrid, I think is a huge counterweight to the fickle money that comes in from some of the foreign institutional investors. So I think mutual funds are in a very good space. They cater to individual investors and institutional investors as well. But primarily, the primary market should be individual investors, and I think we are increasingly see that happen now.
Okay. Talk to us, Mr. Rungta, about the sentiment of investing in markets today, where we've seen that they've more or less been on a flat to maybe, a 1%, 2% sort of an incline. We haven't seen the kind of sharp graph that one was used to seeing on the Sensex and Nifty. And this in the context of higher interest rates on fixed deposits. How do you see that story panning out for retail investors? Do you think that they are still going to be bullish through SIPs or one-time investments into equity mutual funds at a time when banks are returning a decent enough dividend on their investments?
So I think it depends on what time frames you are looking at. Okay. I think moment you zoom out and you see from a larger time frames, then this increase in repo rates and bank fixed deposit rates. If your money is meant for the long term, then very, very clearly, fixed income, even though you may put it in debt mutual funds or whether in bank fixed deposits, very clearly that is not going to be enough to offset the impact of inflation and taxes. And I think the realization is very clear. Investors are looking at the long term, and it's borne out by the fact, as I mentioned, the most heartening figure for me is the increase and the steady increase in SIPs, the number of SIP accounts, and I wish they had also given the number of PAN there. They have given the number of accounts at 6.28 crores.
Yeah, we don't know the number of individual investors there.
Absolutely.
Right. So, but Mr. Rungta, what is
powerful.
happening? Yeah. So, what is happening globally right now? Also, of course, we see and we keep reading about and reporting on US possibly heading into recession. We've seen what has happened with the banking sector. Linked to that, of course, is India's IT sector, and we saw TCS yesterday. Infosys, my colleague Soyash was just talking about today, both missing their guidance. Now, that is bound to play out on markets as well over time. So how do we sort of ensure that the the kind of trust and the confidence that individual investors had in equity linked mutual funds continues? What is it that needs to be done to tell them that this is not a short-term money-making instrument and this is an investment you need to make for the longer term?
So I think clearly that is something that the mutual fund investors have bought in, that a quarterly result or even an yearly result does not matter. Okay. I don't have the data right away, but the average holding period of a individual investor, and I think that's what we should focus on. Okay. The average holding period of an individual investor, my hypothesis is it would have gone up. I do not have the data right in hand for me to say that. And I think that's close to about 2.5, 3 years. That is not long-term enough, according to me, but it's better than, probably the the non-individual investors, where it is probably shorter. So I think the individual investors have finally understood something about how long-term investment works that probably the institutional investors should replicate.
Okay. Mr. Rungta, I also want to touch upon, a specific category in mutual funds, and two of them, in fact, if you'll permit me. One, of course, are the fund of funds that invest globally. And globally, we've seen that over the last 1 year, 1.5 years, they haven't given any positive returns. And the other category I want to touch upon are ESG funds, which again continue to be in question. So for somebody who is who's a citizen of India and making investments in equity, would you suggest that these two buckets, FOF and ESG, should be touched upon at all, or is that not worth diversifying into?
So I think all investments are a matter of asset allocation. I think even FOF can be in the context of domestic investments as well, but clearly you are mentioning it in the context of international
Yeah,
investments, as well as direct international, as well as funds that invest in international
in
equities.
international equities.
I think clearly, see, the market cap of India is about three point something of the overall global market cap.
Right.
Okay. If you are going to concentrate your entire allocation to something that constitutes 3% of the overall global market cap, I think that may not be a good way to do an asset allocation. So definitely for your long-term goals, you need to have a slice of international equity. Now, unfortunately, I think whichever route you choose to go for international equity, whether you use an LRS to send money out, now that will be slammed with a very heavy
Taxes.
tax collected at source.
Yeah.
The FOFs and the international equity funds in India have been saddled with a tax structure that's not very friendly,
Right.
and more upon, even after the tax structure is not friendly, the availability itself is right now under question because of the RBI limits having been reached by most of the funds. I
Right.
think this is a category. I think we should allow Indian citizens to be able to invest overseas. After all, we are a global emerging power,
Absolutely.
and we definitely, part of our soft power is also, retail individuals, investing overseas. Indian tourists going overseas are welcome in every country in the world. You can see countries scramble to, you know, loosen their visa regulations for Indian tourists. We are among the highest spending tourists overseas. We look forward to the day when countries overseas come and woo Indian retail investors.
That's true.
Yes, we need investors. We need our investors to invest in India. But also, I think as a part of diversification, an individual citizen of India should be allowed to invest overseas as well.
Okay, one final question to you, Mr. Rungta, before I let you go this evening. Now, we've seen what has happened with debt mutual funds end of the financial year. So those individuals who were using debt mutual funds as a window to invest and get their asset allocation between equity and debt right, what should be their alternative today? Because the tax incentive they were getting through indexation is no longer applicable. So what, according to you, should be their investment strategy to cater to the debt category in their overall basket of investments? And present day today, any generic formula which may not be linked to a very specific goal, any generic formula of a debt equity and other asset split?
I think generic formulas are dangerous. So I would say that individuals should stick to first having goals and then,
Goal-based planning.
deciding their, absolutely. That's what we do for a living, and that is what we
Do people
advocate.
follow that, sir?
Uh,
Do people follow that? My apprehension with that has always been that hardly ever when I speak to somebody who wants to start an investment, and now you've got apps and you've got plethora of tools available for you to DIY your investments. Hardly ever have I come across any individual who really has a goal in mind. So people who come to you for professional guidance, do they really come with a goal in sight?
See, everybody has a goal. The goal may be not stated or articulated clearly. The goal might be, I want to make the highest return, right?
Okay.
At least that is a goal for most individuals when they are doing do it yourself.
Right.
Our
So
role
for
is to ask them, okay, highest return, what will you do with the highest return? Okay. And there, that process of inquiry leads to, finding out the highest return for what. And then you obviously do trade-offs when
right.
high returns come with high risk. So, you take it, it's a journey, right?
Yeah.
People might be confusing an intermediate stop, high returns, with their final destination. And I
Right.
think it is the job of an advisor to make them focus on their final destination rather than the intermediate destination of high returns.
So, highest return being one of the top level goals, what is the ideal asset allocation in the absence of the tax incentives you got on debt mutual funds? The question I started with, in fact.
Okay, so I think very clearly I've always advocated that debt as a part of an hybrid, okay, where there is equity and there is a self-balancing debt. It's very powerful, okay, and within a mutual fund it's extremely powerful because when equity becomes high in a hybrid fund, a balanced advantage fund, what does it do? It sells equity when equity markets are high. It buys equity when equity markets are low, and the adjusting is debt. And depending on your level of risk and the goal and the tenure, you can decide what your ideal allocation in that is. The power of that hybrid is the fact that it is auto rebalancing, and which by the client doesn't have to do the balancing. The client is freed from the clutches of the greed and fear cycle that normally accompany rebalancing decisions.
Right. So I said that I wanted to, that was my final question, but my colleague Suyash sitting with me doesn't want to let you go that easily. He's got a question for you as well, Mr. Rungta. Suyash.
Sure.
So there's always this big argument, between active management and passive management. And in fact, the data shows that index funds garnered net inflows of about 95,600 crores last fiscal, which was the highest among all mutual funds. And now with most active mutual funds failing to beat the benchmark, do you see the trend or at least passive funds taking limelight in the future?
So before I answer that question, I think one disclaimer, I'm a big advocate of passive funds, okay? But you look at that figure with a little bit of pinch of salt, because I think those figures are distorted by that high number of employee provident fund organizations, the ETFs that they have with SBI mutual fund and UTI mutual fund. Having said that, I think clearly passive funds are a very, very powerful way to take a stake. And people think of index funds only in the context of equity. I think index funds in debt are even more powerful. And unfortunately, till the tax the tax issue diverted it, a fund of fund that self-balances between equity index and a debt index was even more powerful. But I'm sure the mutual funds will find that out. But to answer your question, I think both passive and active have a role. And that is when you do goal-based allocation, that is when that will become clear that, you would have to have a core strategy, something that, gives you returns equivalent to the market at obviously market risks. And for a certain portion, depending on how much resources you have, what's your comfort level, what's your risk-taking ability, maybe you would be willing to take a higher risk in the quest for a higher return. And I think for that, there will be active. Within that, there will be categories. For large cap, should you look at, active or passive? For flexi cap, should you look at active or passive? But those are good debates to have. And I think both have a place everywhere in the world. And I think they will continue to have a place in India as well. Having said that, passive as a percentage of the overall mutual fund pie, individual mutual fund pie at least, is going to grow. On that, I don't think there is any question whatsoever.
Right. So goal-based investing, that is the mantra coming, of course, from the guru of personal finance, Mr. Harsh Rungta. Thank you so much for joining us this evening, sir. And with that, let's move on to another story. And I told you it's a day of numbers, and numbers just continue to to keep coming our way. So in fact, we've got data coming in from CM today. the Society of Indian Automobile Manufacturers, and of course, as expected, there is a massive rise again in the automobile data. So I'm just reading the numbers right now as we speak. In the month of March as opposed to the month of February, cars have seen, or four-wheelers, passenger vehicles have seen a 4.7% rise to 292,000 units. That's almost, give or take, about 3 lakh odd cars have been sold in India, passenger cars. I'm not talking about taxis here. Of course, when you look at the data on two-wheelers, that is much higher. This figure is coming to about 1.3 million, 13 lakh is the data that has come in, as opposed to almost 12 lakh units sold in the month of February. Now, of this, and this is an interesting trend which I've noticed on the streets, and I'm sure all our viewers tuning in from India and especially the metro cities in India also would have noticed that SUVs, sports utility vehicles, have accounted for about 50% of the sales. Now, that's of course a fairly high number, given that the cost of or the price that the end consumer has to pay on SUVs is much higher. So, this is the number that is coming in from SIAM today. I've got with me in the studio now my colleague Rakesh Kar, Business and Economy Group Editor at TV9 Network, joining me. And I really want to start off by asking Rakesh, are these numbers, too good to be true month on month as we see them rising higher and higher? Are these numbers too good to be true? And what do they tell you about the Indian economy?
I think they're quite in sync with what's happening in the Indian economy, which is kind of a outlier when it comes to growth perspective.
Right.
I was just reading the latest approach paper done by the World Bank on global forecast, which sends out a very, very negative signal, which says that 2023 is probably going to be the lowest growth rate in comparison to 2009, if that is the benchmark, which was the recession.
For India or for the world?
For the world. I'm just coming, and then 2009 has been the worst year. It could probably beat that. Okay. And then it's also talking about 2020, which was the next worst year, if we can call it.
Of course.
And so that's the projection, which has just come today. It's an approach paper.
Right.
It's not fully ratified by World Bank, but it's there on their website.
Right.
And in that sense, the Indian growth story is obviously, it's already been defined as the bright spot, though all economic world think tanks have revised the data downwards, unfortunately for India as well. But I think two macro points. First of all, the consumption level in India for each product category is so low that it is bound to grow.
Okay.
And when you look at number of cars sold in India versus China, we are way below.
Right.
Of course, it has got lots to do with our per capita income and the way we are versus China's or US's per capita.
Right.
But the appetite and the aspiration is phenomenal. So in that sense, the numbers that we've seen for last year is also on account of the buoyancy because of post, the pent up on account of COVID. Will we sustain that? There are challenges on that. I think, there is a problem and there is division in terms of the opinion whether we will be able to keep the tempo on the numbers that we have achieved for all product categories, more so for cars, because there has been a lot of buoyancy. The good thing is that on the two-wheeler cycle, because two-wheelers is directly linked to what we call the rural economy. So in that sense, the rural economy has done pretty well, and that's the good signal. We'll have to wait and watch exactly how the numbers look like next year. But for now, it's a very, very positive outlook.
Okay. Now, talk to us also about, we know that FM is in Washington and there are multiple projections coming. In fact, IMF came with a projection yesterday stating that India's growth rate, though higher than China at 5.2, is likely to be at 5.7 versus our own internal estimates of 6.5% or so. Previously, World Bank had said 6.4, Asian Development Bank had said 6.3, or vice versa. Honestly, I don't remember the numbers that well.
Yeah, they keep
but
changing.
They keep changing. They keep changing. They come in such volumes, and this show today being so much about numbers, in any case, there are numbers all over, flying all over. But, if the auto sector sort of were to represent the growth driver of the Indian economy, in that context, a 6%, 6.5% growth, what does it mean for the auto sector specifically, given the fact that this year alone, and again, I've got numbers here, Rakesh, we've got if I talk about the financial year, not just the numbers of March that I just spoke about briefly, for the financial year, we've sold almost 4 million cars in India. 38,90,114. Those are the number of cars sold, manufactured in India, sold in India. Now, part of this, of course, could also be the export market, which has incidentally reduced. So, overall exports have come down in passenger vehicles. But a year-on-year if you look at a March to March year-on-year comparison, numbers have grown 14%. Vis-a-vis our projected economic growth at about 6.5%. What does this tell us?
I'm an eternal optimist, but I must quote from the industry leaders who themselves in the car passenger category have said that it would be difficult to sustain this kind of growth next year. There are a variety of reasons for that, as I mentioned, the global outlook and the fact that we may not be able to keep, and the numbers for the overall economic GDP are falling every day in terms of the estimates. So Government of India has repeatedly said that it's bound to stick to the 6% number, which again is a very positive number. But auto leaders, especially the passenger car leaders, have projected, if we use the term guidance like you used in the IT sector, that we will not be able to sustain the growth at the level that we have done over the last year.
Right.
Which is still good news.
Right.
I think, if we're not able to do 14%, we have to do about 10%. That's a positive number.
Okay, so stay with us, Rakesh. We've also got Abhijit Sinha joining us live. Abhijit, of course, is the National Program Director, Ease of Doing Business, and he's also the Director of National Highway for Electric Vehicles. So, Abhijit, I want to actually throw some numbers your way as well. Of course, we've seen the auto data that has come in today, and this is across both four-wheelers as well as the commercial vehicles, as well as passenger vehicles, four-wheelers as well as two-wheelers, and all the cuts therein. And we spoke about SUVs as well. But I want to specifically come to you on electric mobility. And about 2-3 days ago, we saw that the electric vehicles in India had breached the 1 million mark. Now, again, if we were to break this down, we were talking about, I think, some 62% coming from three-wheelers, 34% coming from scooters, and about 4% coming from electric cars in this overall mix of 1 million electric vehicles that were sold last year. Now, all industry analysts, experts that we had spoken to earlier were really betting on FAME 2 to continue. Now, this was a policy initiated by the government to help reduce the fairly exorbitant prices of electric vehicles in comparison to their, traditional fuel, petrol or diesel counterparts. So I want to specifically, ask you to help our viewers first understand what was FAME 2 versus FAME 1 and the likelihood of FAME 3 coming out. So we'll start by, helping us understand what was FAME 2 and what's the real logic, rationale behind the government possibly phasing out that, that policy which gave a 10,000 crore rupee impetus to the EV sector.
Good evening, and I believe I'm audible to you.
You are very much loud and clear.
It's a very good decision to discontinue FAME at this stage of time. This is a very strong statement which I'm putting up, but it is actually a gradual development of policy from where the electric mobility industry is automobile itself. And auto industry, when it started its electric venture, they were a bit difficult to understand which thing should be compared with what. So electric vehicle compared to a non-electric vehicle, fossil fuel or diesel or petrol vehicle is a bit unfair comparison. Ideally, after spending a lot of time in FAME 1, FAME 2, I can quote from 18, 19, 20, 21 and 22 budget speeches that gradually government went and tried to improve and extend some support to infrastructure, then production link, then when it is required in last 20th budget, 2020-21 budget, it also announced a certain amount of tax exemption to people who are buying it. So when you are giving all these, what do you expect in return? Is a high growth sale and also a transition in people's life, that people adopt it. But policies, it is growing, it will always grow into three different parameters. One, which is very well articulated, is production linked, which we now call PLI, production linked. It is focused on the manufacturing. Second is pre-sales. Pre-sales is you are going to buy as a viewer and you are getting in subsidy, so your price is subsidized. Third is the actual displacement. So I think the Indian electric mobility industry has now reached on the third phase, where the actual displacement is more than important than anything else. An actual disbursement model is not FAME, it's not subsidy, it is like carbon credit. You buy a vehicle, you drive certain kilometer, which you could have driven on fossil fuel. But since you have driven on electric, a certain amount of direct benefit is given to you. That is not subsidy. That is not on the manufacturing support. And in gradual expectation, if you will see the reform statement of government, this government is proven to be a very strong government for doing reform. One very important example, because electric mobility cannot operate without infrastructure. And infrastructure is like petrol pump and charging station. We compared an electric car with petrol car or diesel car, but we never compared a petrol pump with the charging station. And that is where it comes that if we could have done that, if we could have started this bit before, then we would have more highways which are electric, we would have more cities and more transmission and more routes which are electric supportive. This gives more confidence to the people and user changes their mindset. Now user is not bounded to buy electric vehicle. With the emergence of new fleet operator like Blue Smart and other who are 100% electric fleet operator, they started giving electric vehicle to people without buying it. So the load of buying electric vehicle is now the next pattern change in the automobile user. And this load is asking more and more. Now we are operating Delhi, Jaipur, Delhi, Agra, Delhi, Chandigarh, all these cities and their communication, their interstate mobility is also having a new alternative, which is electric. With this change, the comparison of petrol pump and charging station came evident. And with the pilots, which we have been doing like National Highway for Electric Vehicle, we compared a petrol pump with a charging station. And this also gives a lot of boost to the investment into electric mobility, because each electric mobility investor is not predetermined to invest into manufacturing or to invest into fleet. They also come as a neutral investor, and neutral investor always look for the profit. And during these 7-8 years, electric mobility did not proven to be profitable, except certain exceptions. So our idea and the government, you can say, thought process is now in that direction, where manufacturing has been given enough support, people have been given enough tax exemption and other things. Now it's time to move on the actual displacement. And actual displacement is giving you comparison that you are going from your city to another city. You asked for an electric bus, it's available. It's on a 60% lesser price available for a seat. If you ask for a car electric, that's also available. You want with driver, you will be getting with driver. We want without driver, you are getting without driver. So the load which is changing is dependent on the infrastructure, and the comparison between petrol pump and electric charging station was very well defined in 2018 by Power Ministry, that there is no license required. And this is a very big message. Petrol pump is still a license activity. Charging station, setting up a charging station as big as petrol pump is not a license activity. Since you're going to set up, you only need 3 things. You know what is the layout and designing and the detailing of the charging station. Second, you know the financing spectrum should be there to support when you're setting up. And third, you must be knowing that how much a charging station is going to earn for you. BJP, all these 3 things, detailing, financing, and the earning, is very clear and available in the market for petrol pumps, but not for charging station. With this bold reform in 2018 of Power Ministry, Government of India very clearly given a site that set up and do your business. Private fleet operators with subsidy, without subsidy has started doing their business. This gives a very positive outlook. People who are agnostic of the manufacturing or the fleet operation, they also are coming as an investor in the sector, and it is rising because profitability is very, very clear and very sorted.
Right. So I want to actually understand from you a little more in detail. So, of course, you're saying that enough subsidy has been given to the manufacturers of electric vehicles as well as the consumers of electric vehicles. Not as much has yet been done, and that is in a course correction mode on creating these electric highways and having more charging stations available and making them a profitable business model. I'm totally in sync with you on that, Abhijit. But, the conflict in my mind right now stems from the fact that we are actually not talking about a chicken or egg situation. We are talking about a chicken and egg situation. So the point is, if you take away the subsidy from the manufacturers, the price of electric vehicles shoots up. If that shoots up, you have lesser takers to actually go ahead and make those expensive purchases on electric vehicles. And by that time, if you're building a highway which is going to provide enough charging stations, but there aren't enough takers or enough visitors coming to those charging stations, it doesn't become profitable. So don't you think it's a little premature to withdraw the FAME 2 subsidy altogether rather than phasing it out gradually?
Very, very nice question, because this is the very prime oversight with this withdrawal gives.
Exactly.
Everybody and anybody. If you address the pocket of the user, which is using a nice engine right now, diesel buses or diesel trucks, they have a certain amount to be paid for a distance between certain cities and also inside the city. This amount, when it is compared with electric, it is already half. But the capital acquisition cost of an electric vehicle or a bus or a truck is very high. This is why the FAME subsidy on the manufacturing and other thing we're given. Now, instead
Sir,
of that,
I completely agree with you as far as commercial vehicles go. I understand the business model for commercial vehicles, right? Because at the end of the day, you're paying a subscription, you're buying a ticket. So it's public transport. You're not really owning that asset as an individual. But I'm talking more in the context of, let's say, the Niti Aayog set vision for 2030, where we say that we want 70% if I remember correctly, or 80% of our two-wheelers to go electric and about 30% of our cars to go electric. I'm talking purely for the purpose of a prospective buyer of not a commercial, but a passenger, a consumer-driven vehicle of electric mobility.
So, for an example, if you are paying 80,000 rupees to buy a two-wheeler, and there is a certain amount of subsidy, if this subsidy is drawn, your price goes 1,20,000 rupees. But at 1,20,000 rupees, when you are driving, you are also getting a certain amount of carbon credit, which is now being introduced together. The PLI scheme continues to be supporting the manufacturing sector so that the manufacturing increases and meets the demand. Manufacturing increase and the sales increasing, not depending on the initial price slash which you were getting because of PLI, because of FAME, is the only difference. So if I drive 100 kilometers every month, I am also getting benefited out of it. This benefit is coming to me directly. Earlier, it was coming when I was buying an electric vehicle. That's the difference.
So explain to me, how does this carbon credit sort of, get implemented at the end user level? What is the kind of offset that one gets in lieu of the carbon credits that you generate by buying as well as driving an electric vehicle?
This offset is, as of now, the conceptual design, the conceptual thought process of bringing carbon credit is also connected with the grid, and it is also directly connected with the tax structure which we employ on the oil import bills. So what amount of energy you would have consumed if you had driven that particular kilometer on fossil fuel is directly involved into deciding that carbon credit per kilometer. The kind of vehicle, the vehicle consumption, its mileage, everything is considered into that calculation.
Okay, my colleague Rakesh is sitting with me in the studio. He's got a question for you, Abhijit. Rakesh.
No, before I have a question for him, I just wanted to understand, someone has to pay, there are no free lunches, Abhijit, isn't it? At the macro level, it's very good to say that everybody should be invested in the idea of moving and, getting into the displacement and paying for it. But from a consumer perspective, again, I'm repeating what Kartik said, industry, it's a new industry, it has its own challenges, it's capital intensive, and there are concessions. But how do you take away the expectation of the industry that if I have to grow this segment, I must be subsidized?
Expectation is divided into two segments. One, where I buy a vehicle. Second, I only use a vehicle. When it comes to only use a vehicle, it's more infrastructure and the PLI is more important than subsidy. That is proven. All large vehicle and intercity transport, that segment was not very helpful with the FAME. Second, if I go to buy a vehicle, when I'm buying a vehicle, then definitely it is prima facie going to look like it is going to go up. But soon when you are using the total cost of ownership and the total cost of running that electric vehicle, if it is clubbed with a benefit which is not being paid, directly on the FAME side, but it is paid on the PLI side to reduce the cost. You must have heard recently our road transport and highway minister saying that electric vehicle price and the diesel vehicle price, two-wheeler, three-wheeler at least, is going to be very soon equal. That has an economics behind it. That vehicle today is being sold with batteries. Tomorrow it will be sold without batteries. So battery coming on subscription itself reduces 30% of the cost. So such definite models which are giving and which are reaching to the user a bit late, a bit after the displacement, after the actual traffic or actual sales has already occurred. That's called post sales. Right now, all subsidy model are pre-sales at the time of manufacturing, at the time of sale. Post-sale is the mature market, and India is now reaching to that mature market where what you create, what you build, what you manufacture, government is not going to get into it. Government is not going to subsidize you for this. But when your product is taken by the user and user is going to use it, then in different manners it can be given. Be it a battery subscription model to ownership of battery. If the cost of the vehicle is going up, you may still reduce it by giving battery on the subscription. That's why this year in the finance minister's speech, it was very clearly explained that India is going to bring the battery swapping policy. And the draft also came within 90 days of the announcement, and now it is almost on a final position to give everyone who is buying a vehicle a 30%, 40% slash on the pricing. So no matter how manufacturing is going to happen, how manufacturers are going to take it, but users are going to get benefited. From the manufacturer side, I agree with you that it is not meeting expectation, because whenever you give subsidy in any economy, it's a kind of dependency developed for a year.
Rakesh, you want to add to that?
Yeah, I would say that it's a very interesting debate, Kartik, because what's happening that, someone has to pay for this new industry that has to take shape.
Yeah.
And Government of India has mandated itself to meet the transition.
Right.
And there's a huge cost to it. But subsidy as a policy, as instrument of policy, is coming under scrutiny globally. There's a book which has been released yesterday by a well-known economist in the US, incidentally called Ashok Modi. It's called Broken Reforms in India, which is centrally questioning the PLI scheme.
Yeah.
It is questioning PLI scheme, linking it to the political economic architecture in India. It makes this point, though I don't agree with it, but it says that this is again a reason for Government of India of the day to give a subsidy to corporate India to fatten its profits.
Yeah.
So, when PLI, which is being hailed here in India and by a section of the global world for giving a boost to manufacturing, is being criticized. And if you look at it in context, this argument cannot be completely, so to say, thrown away in the dustbin. Because Government of India, a Modi government gave corporate tax concessions. So, if you see systematically, that was one big historic reform.
Right.
Second is that the PLI scheme, it's a huge incentive.
Right.
Third is incentives for manufacturers, like we mentioned in the EV category. So, put together, I think Government of India has limited resources, and we are in an election year. Increasingly, how it is dealing with the corporate world in terms of how is it facilitating the corporate growth in India, which is again a valid point, because if you don't have private sector investment driving the growth, we will not have economic growth.
I agree with you, Rakesh, but I think, just to sort of, if I may, to sort of bring back Abhijit's point on this, I think what he's trying to say is that there is still enough incentive given to the sector, except that instead of it being a push, it now becomes a pull, where you take away subsidy from the manufacturer and let the manufacturer sell it at the retail price, and you sort of bring in reforms on the supply side of battery swapping, electric charging infrastructure,
I
etc.
think an interim solution could be to sort of say probably halve the subsidy for the manufacturer, sustain the tax incentives for the consumer, and ultimately the government should prioritize its investment in building the infrastructure for the EV setup. That's what he calls displacement cost.
Right.
So I think if that is done in a judicious manner, we probably stay committed to the course of moving from fossil to the energy efficient mobility. At the same time, also not come for criticism of unduly fattening the corporate sector profitability, which in this case is not yet happening for the EV cars.
Last word to you, Abhijit, before we wrap this up. 30 seconds, if you can just quickly react to what Rakesh is saying.
Absolutely agreed with his views, and also this policy of subsidy is not only in India, across countries across the globe, it is under scrutiny. If it is not now being removed, it is going to make the industry more dependent on it. If industry will get more dependent on it, this will be a continuous cost for Government of India. And it will become another Department of Health and Department of Education, where if you're not going to assure the profitability, the international market and the investors market, they also look at it that how long government will be able to hold it. We have a couple of examples where subsidies were given for a period of time and then it did not continue. If it was government tried to remove it, the industry collapsed. Not in India, it happened outside India. I do not want to name the country, but it happened this way. So for us, you have absolutely got it right that subsidy will still go. Incentives and the push and whatever support can be extended to industry will continue going, but not to manufacture. Sometimes the half is a good idea, a brilliant idea, but to users it is still reaching. User is requiring a very smooth lineup, and it is also the industry also has to grow one more step ahead. When you are going and using an electric vehicle, the power which you are going to take from whichever source is also need to be solar. So solar, the entire sector of solar is also looking at a certain subsidy. When we give and distribute these subsidies to in right amount of transition, then only we achieve to net zero. And for doing this, we need to look at it that we cannot concentrate entire amount to one of the sector or one particular segment of the sector. It has to go to solar, it has to go to user, it has to go to battery development, it also has to go to infrastructure, then the fleet operator. Right now, there is no subsidy to fleet operator. It's shocking. And fleet operator are those people who are giving you vehicle without you buy a vehicle. So transition, if you're talking about, it's not one person. It's a multi-stakeholder transition, and all stakeholders need to be for a certain period supported by the government.
Right, Abhijit, Rakesh, thank you so much for joining us here. Excellent debate, and of course we could carry on and on, but unfortunately we are heading out of time. But I want to quickly shift focus from electrics to electronics. So shifting focus to specifically mobile manufacturing, which has hit top gear in India with mobile phone exports crossing 11 million. That's the number of mobile phones exported from India. The growth in mobile exports has been primarily driven by Apple phones, which alone crossed a record $5 billion in export value, not number, export value, because Apple phones happen to be far more expensive than the others, from India in FY23. Apple reportedly clocked 50% share in the export of made-in-India phones. Samsung came in second with a share of 40%. The trend of mobile phones continuing to contribute heavily to manufacturing and exports will come to see more thrust as India looks to further fortify its status as a leading economy. Meanwhile, smartphone maker Vivo has said it will invest 1,100 crore rupees more by the end of this calendar year 2023 to scale up its manufacturing capacity in the country, while production in its upcoming unit at Greater Noida is expected to commence by early 2024. Vivo India also said it is on track to export more than 1 million made-in-India smartphones in 2023, having sent its first made-in-India smartphone shipment to Thailand and Saudi Arabia last year. As part of its 7,500 crore proposed investment plan it had outlined, Vivo is on the way to complete the first phase of investment of 3,500 crore rupees by the end of 2023. Now, of course, if you are a smartphone user, which we assume you would be, then make some good use of your smartphone. Where you're watching this video, you'll find a little subscribe button. Go ahead, hit that subscribe button so that you don't miss any update from Business Plus and News9 Live. Till then, thank you so much for watching, and we'll see you again tomorrow with hopefully lesser numbers but more news. Thank you so much for watching. Goodbye.